Welcome back, everybody. It's May 9th. Today, we're going to look at Shopify's Q1 earnings, April's job data pointing towards stagflation, and US capital rotating into Canadian resources. Let's get straight into the story. Shopify released their Q1 earnings and reported a noticeable slowdown in gross merchandise volume. The stock saw immediate downward pressure as growth expectations were reset. The discretionary consumer is tapping out. With energy and food costs remaining high, the non-discretionary expenses we have been tracking is eating up disposable income. People are spending their money on necessities, leaving less for online storefronts that power Shopify. This puts heavy downward pressure on Canadian tech valuations and consumer discretionary equities. I expect consumer discretionary brands cater to lower income class to struggle through this summer. The needs shift away from growth stories and towards companies with actual pricing power. If a company relies on people buying things they do not need, its margins will start to shrink. Friday brought the labor force survey for April. Unemployment ticked up to 6.9%, up 20 basis points from last month. Yet, wage growth remains stubbornly high at 4.5%. These are key signs of stagflation. Economic output and hiring are slowing down, but workers are still demanding higher pay to keep up with inflation. This puts the Bank of Canada in a very difficult position. They cannot cut rates because wage growth will fuel more inflation, but holding rates steady hurts an already weakening job market. Bond yields remain high, which shows up in the long end of the yield curve and affects sensitive sectors. I believe we will see a hold for much longer than markets expect. Investors need to prepare for a prolonged period where interest rates stay elevated to fight off wage inflation. We're tracking a quiet but massive flood of money flowing into Canada. Recent data shows foreign direct investment into Canada just hit $96.8 billion. This is the highest level of annual capital inflow we have seen since 2007. Global capital is looking for a safe place to park money during these severe global supply shocks. Reports from major banks show that this money is not just blindly buying the index. Institutions are focusing heavily on commodities, with estimates showing hundreds of billions in capital needing specifically for Canadian metals, minerals, and energy. Canada is unique because we offer hard assets the world desperately needs right now. The effect shows up in our energy and mining companies. We are absorbing record levels of global institutional capital, boosting their valuation right now. I suspect that this trend will accelerate if global political tension continues. This capital influx creates an opportunity in base metals and energy infrastructure. If you are holding the broad TSX index fund, understand that your real underlying strength is coming from the foreign money pouring into our resource sector. Tech and consumer spending are facing real headwinds, while resources are acting as a global management for capital. You need to know what side of the divide your portfolio is on and focus on capital allocation. This is Union Stock. We don't guess, we analyze. See you next week.